I'm Brian Chu, editor of Rock Stock Insider and Gold Stock Pro at Fattail Investment Media Research. Today, I have the pleasure of chatting to a special guest that many of you have a lot of respect and admiration for, including myself. This guest has no doubt helped many do well in navigating across a dangerous yet exciting field of gold mining investments. He has over 40 years of experience and an illustrious career in mining investment, funds management, and financing. This means he has lived through and prospered across countless commodity cycles. Currently, he's semi-retired, but continues to offer his insights through his own established media company, Rule Investment Media. I believe many of you listen to his podcast and follow his research. It is my pleasure to bring to you Rick Rule, founder of Rule Investment Media. Hello, Rick. Thank you for giving us your valuable time to talk with me and share your insights.
Thank you in turn for both your kind introduction and the opportunity to address your audience. I enjoy it.
Well, let's kick off with the first question that I think many investors are wondering. The gold market seems to have been stagnant in the past year after a really good run over the last year after COVID. What do you see in the horizon with the price of gold?
Brian, it's important that precious metals investors understand what I call the anatomy of a gold bull market. I'll refer in this interview today to a chart that I use frequently, the Barron's Gold Mining Index, which is the most inclusive and longest running gold equities index that I know of. And several things I want to leave with your audience. The first is that traditionally, precious metals bull markets are long-lasting affairs, the duration of 10 or 11 years. I suspect that we're 3.5 or 4 years into this one. So when people are afraid that this bull market has run out of steam, I need to tell them that if past is prologue, we aren't even halfway through the game. The second is to mention, in the first bull market of my career, 1970 to 1981, the gold price advanced from an admittedly price-controlled $35 an ounce to a high of $850 an ounce. Impressive performance indeed. The second bull market, 2000 to 2011, was more muted, if that's the right word, with gold advancing in US dollar terms from $253 an ounce to $1,900 an ounce. So when people say to me, Rick, in US dollar terms, the gold prices advanced from $1,000 to $1,700 or $1,800. Have I missed the boat? I need to say, if past is prologue, not really. In direct answer to your question, Brian, an examination of the same chart or a different chart involving physical gold or physical silver will show you that cyclical declines in secular bull markets are common, normal, and natural. And they can be of quite severe dimensions, distressing, of course, for investors. But the point of a bull market is not to calm investors' nerves. And so my suspicion is that you need to familiarize yourself, with markets in the past so that you can understand the market that we're in. The fourth thing I might say for free is that price declines in markets for physical goods are regarded as sales. If you yourself was shopping for a winter coat and you found a coat that you had expected to be on sale for $300 for $200, you'd be delighted. But if the gold price, something that you might think would be of use, falls by 30 or 40%, rather than being delighted, you're unnerved. So I think that people need to begin, to understand precious metals markets and other markets for what they are, and understand that they are driven, not inexorably higher, not in stair steps higher, but rather in fits and starts, and understand that if you want to own something, that you prefer it cheaper rather than dearer.
That's actually a good point you make, Rick, especially in regards to people's mentality being you want to buy when things are cheaper, except when it comes to investment assets. And this leads me to the next question, which is last Friday, we saw a big gold smackdown and we thought $60 an ounce, US dollars an ounce. That was pretty big. But how many people saw that one coming on Sunday at 6 p.m. US time? It went down another $60, $60, $70. So this is another big drop in the US gold price. And you've got people who are so scared about, well, we had a pretty bad year in gold, and is this the end? And I see that you're saying it's not, but is there a US jobs recovery and an economic recovery? And therefore, could that threaten the gold price further?
Well, that's a great big question. So let me take it a bit at a time. The first thing in terms of seeing the declines. One almost never can understand the nature or foresee those precipitous declines, but an examination of history will show that they occur, and they occur fairly frequently. If you can't stand that, you need to find sort of another thing to do with your money and with your time. I believe very much that the bullish case for precious metals is intact, particularly as an American with regard to the US economy. But my belief is that precious metals do well in times of fear, and particularly in times of fear concerning the purchasing power of conventional savings assets, and particularly conventional savings assets denominated in the US dollar. So let's observe whether people should be afraid. Let's observe the fundamentals behind the precious metals bull market. The first is, of course, quantitative easing. Quantitative easing could be better defined outside government circles as counterfeiting. It's the printing of specious currency. The fact that they consistently print currency faster than the economy grows will tell you, in fact, by definition, that it's almost always specious, counterfeit currency. And whether or not you believe it's good policy, you can't deny that debasing the currency is something that would make people concerned about the efficacy of their purchasing power denominated in that same currency. More pernicious, of course, particularly for someone of your age, Brian, is debt and deficits. I don't know the applicable Australian number, but in the US, at the federal level, we owe the federal government owes various creditors $29 trillion in on-balance sheet obligations. That's 12 zeros, Brian. People's eyes glaze over when they think about that, but they shouldn't. It's simple arithmetic. More concerning is off-balance sheet liabilities, the net present value of obligations like pension obligations, Medicare, Medicaid, Social Security, things like that. So the net present value of the US government's obligations exceeds $150 trillion. We propose to service this with a budget that this year will be in deficit $6 trillion. Now, you're taught if you're in a hole to stop digging, but the fact is that we dig ourselves $3 trillion a year deeper in this hole. Many people have suggested that this debt will never be repaid. If this doesn't give you concern about the efficacy of the purchasing power of US dollar-denominated savings, one wonders what might. But the answer, of course, something to make you more afraid, is negative real interest rates. Negative real interest rates cannot be a force of nature. Why would you pay somebody to have them take your money? Why would you accept their credit risk and pay them in return for giving you risk without return? Why, too, would you forestall consumption in favor of somebody else and pay them to consume your capital while you waited to consume it later? This is truly stupid. Let's look at the arithmetic around the world's benchmark savings instrument, which is the US 10-year Treasury. This instrument pays you 120 basis points, 1.2% a year, in a currency which the Congressional Budget Office, not some fat old crank named Rick Rule, says is declining in purchasing power by 4.5% compounded. What that means is that your real yield is subtracting 4.5 from 1.2. Which means that for the first time in my life, Brian, the US government is telling me the truth. They're telling me that if I give them money for 10 years, they're going to give me back much less 10 years from now. Jim Grant calls the US 10-year Treasury return-free risk. And so gold really is fighting a war with return-free risk, which I think it can win. Finally, Brian, there's market share. Precious metals and precious metals-related assets in the US market comprise less than 0.5% of total savings and investment assets in the US market. That's down from a 3-decade mean of between 1.5% and 2%. If quantitative easing, debt and deficits, and negative real interest rates, if that arithmetic begins to cause people to be nervous, gold doesn't have to win the war against conventional instruments, it just needs to lose it less badly. Specifically, if precious metals were to regain their 3-decade mean market share, demand for precious metals and precious metals investments would triple in the largest savings and investment market in the world. And I don't think that's too great an ask. I think that's precisely what's going to occur. Will it occur in straight fashion? Will it occur before the next Australian long weekend? I don't think so. But I think that that outcome is absolutely inevitable, even if it's not imminent.
Yeah, that's a good point, actually, especially given that the only way to get out of debt is to pay it off, and your governments and your households and your corporations seem to like ladling much more debt onto their plate and hoping that this would actually magically inflate away and turn into productivity. Now, that being said, I think a lot of investors, they see things in the short term, but they lack either the patience or the insight to see the longer term. Now, the best investors would thrive throughout any market cycles, not just in a bull market. Can you share some of your best trades in the last year as gold started coming down?
Well, with the caveat that I'm not a trader particularly, I'm an investor. It's odd, Brian, that at age 68, when I have less time on earth, I've become more patient. I guess that's experience over hope. What has worked for me this year is I began to see, particularly the more speculative parts of the minerals markets, overpriced in the middle of last year. And I switched fairly aggressively out of sub-billion market cap companies into much more stable names like Franco-Nevada, names like Wheaton Precious. And what that means is that while I'm not happy with my absolute performance relative to some other years, I had a positive year in a year where most precious metals managers were negative to strongly negative. My own belief is that sooner rather than later, I'm going to get help both from the gold price and for the gold equities. And so what I'm doing right now is reversing that trade. I'm taking myself out of the safe havens that I was involved in, including liquidating a bit of bullion, which I believed is a safe haven. And I'm moving much further out the risk scale, simply because everybody else has done the exact opposite thing. Several speculative indexes have fallen by 50% in the last 12 to 14 months. 50% off is an attractive sale, irrespective of the goods that you're looking to buy.
Yeah.
But let me say one other thing, which I should, talking about duration. You are right that people lack patience. And I think that people who lack patience are often people who don't have the courage of their convictions, people who haven't studied their investments enough that they can take a little bit of turbulence. Warren Buffett has said a couple great things about this. He said that you shouldn't buy a share of stock in a company if you wouldn't be prepared to buy the whole company at that price if you could afford to do so. The second thing he said is that you shouldn't buy any stock if you wouldn't be delighted to see the share price fall by 30% the month after you bought it, so that you could employ the same intellectual capital to use more physical capital on an investment that you were sure of. Now, sadly, I've been tested by that thesis a few dozen times in my career, and it hasn't always been pleasant. But I'll tell you this, the very big wins in my career, the 10 baggers, the 20 baggers, all of those shared two common features. The first was that it took 5 or 6 years to take place. And the second is that in every incident I can think of, save perhaps one where I got just plain lucky, the share price of the company at hand fell 50% or more during the course of my holding it. So not only did it take me 5 or 6 years to get a 10 bagger, At some point in time during that holding period, the share price declined by 50% or more. The price that one pays for riches like that is occasionally, in the short term, one's sanity. But the truth is that the expectation that something will occur quickly or without volatility is an unrealistic expectation and will stand in the way of your investment success.
Actually, Rick, I like the fact that you're quite bullish on the speculative side of gold stocks, and that you again remind investors who are watching this at home that it's actually a good thing if after you purchase a stock, it falls 30%, as long as you have the courage and the conviction, you could be well rewarded. Because this is something I personally went through, and it was listening to you back in 2013 and having lived through 2013 to 2015 that I made those pretty spectacular gains. I also will tell you guys all a little bit of a funny story is that I was lucky that my girlfriend at that time got into gold stocks in 2015 as it was going up after I went through the horrible drops, because she's now my wife. And if I actually got her in early, I think I'll probably be single still. Now, moving to the next question, which follows on really nicely to it, is many investors know how to buy into a rally, but only a few get it right selling out before the party ends. What would be the signs you look for in the next, in the bull market to head for the exit the next time?
Well, if you believe that the probable cause of the bull market is quantitative easing, negative interest rates, debt and deficits, and market share, then you would look for a cessation or a reversal of those fundamentals. You would look for a circumstance where quantitative easing around the world ceased. You would look for a circumstance where government budgets were balanced or were at least constrained to below the rate of economic growth so that they appeared serviceable. That you would look for an end to negative real interest rates, and you would look for gold to become popular as opposed to unpopular or despised. In particular, you would look to the market share of precious metals and precious metals related assets to return to the 3-decade mean, or more likely, overshoot the mean. It is estimated that the market share of precious metals and precious metals related assets in 1981, which was the height of its popularity, no statistics exist for that, but it's estimated that the market share of precious metals and precious metals related assets in US savings and investment markets exceeded 7%, rather than 0.5% today. So if you saw a circumstance where the factors that were likely to propel precious metals higher were becoming no longer so extraordinarily bullish, you should look to one's exit. In the equities, you have a different circumstance. The junior equities is an example. The sub-billion-dollar market cap space last year became stupidly overpriced relative to the gold price. It's important to remember in the speculative part of any market that there are many more losers than winners. Your audience will be distressed to know, I think, Brian, that my belief is that if you merged every junior exploration and development company in the world, Australian listed, Canadian listed, AIM listed, into one company, we'll call that Junior Explorco, that company in a very good year would lose $2 billion, expenditures over realized sales and profits, and in a bad year would lose $6 or $7 billion. So your audience needs to ask themselves what a business that loses $2 billion a year is worth. Is it worth 7 times losses, 11 times losses? Is it worth, because it's in a glamour industry, sometimes 15 times losses? My point of all this, other than to get your audience to laugh, is to say that probably 80% of the junior companies in the world at any given time are valueless. It doesn't mean they won't go up in price, but they're valueless. That means that less than 20% of the companies in the sector can generate such spectacular performance that they add credence and occasionally luster to an industry that loses $2 billion a year. When you have a circumstance like last year, where a conglomeration of butchers and bakers and candlestick makers in, Western Australia could stake some kangaroo patch, and the market cap would go to $70 million when they had $1.98 in the treasury. I mean, there are times when you just have to take leave of a speculative sector, even when the underlying fundamentals around the commodity it produces are bullish.
Yes, actually, that was a very good answer, Rick. You brought up quite a few points that I want to reiterate to the listeners out there. Firstly, it's if the economy shows any sign of recovery, and that could be possible, such as positive real interest rates, that could be a sign to show it's time to exit gold. And another, which is even more important, it seems like, is with the gold market, when people get very excited and you're seeing just any like your Joe or Jane coming into gold stocks and picking any one of them indiscriminately, then it's going to lead to an overpriced market. And I guess you also answered the final question that I was going to ask was, what were your thoughts of the Australian gold and silver industry? And you've put it in quite in pretty neat terms. Firstly, some of these explorers are actually losing, and therefore they don't justify the price in which the market's giving them value for. So in that case, how would you pick the best ones out of the basket of potential losers?
I need to qualify the question by saying that not all investors are created equally. What's appropriate for a 68-year-old foreign professional, as an example, might be very different than what's appropriate for the average Australian punter. I need to say at the beginning of the answer that I consider the Australian mining sector to be the finest and the strongest in the world. There's something about your isolation. There's also something about the fact that Australia is a resource economy. That means despite your government's best efforts to kill it, the Australian miners come back again and again and again. You have critical mass in the academy, in human resources, in legislation, in financial services. You have a spectacular geological endowment in Australia, and you have an industry that's proven itself offshore, off Australian shores for 30 years. So I believe it to be the finest single mining market on the planet. I believe too that what would be called the global mid-cap with regards to Australian listings are cheap, probably the cheapest in my career. I define cheap by looking at the net present value of proven reserves, future cash flows defined by the forward strip and gold price, relative to enterprise value, which is market capitalization and cash minus debt. By that metric, a purely financial metric, these stocks are the cheapest that they've ever been in my career. But I also believe that we are mid-cycle in Australian exploration, which is to say that Australian companies began funding exploration 3 years before companies did in the rest of the world. Typically, an exploration cycle takes 7 or 8 years to mature, which is to say it takes 7 or 8 years of applied exploration expenditure before you come into a discovery cycle. And I think that Australia is coming into a discovery cycle now. And assuming that the underlying fundamentals stay intact, for those speculators who have access to the knowledge to understand the exploration process and can afford both the volatility and the absolute risk associated with the sector, my suspicion is that although the Australian mid-caps are the cheapest, select Australian explorers will reward those who can afford to take the risks the best.
That's actually very heartening to hear, Rick, especially now that we're entering into a season where gold would normally have rallied, except it's being held back a little bit. And yes, I believe that we will be seeing some interesting discoveries that will come in the various regions, either in Western Australia, South Australia, and even parts of Northern Territories. So hopefully that will come sooner rather than later. Well, Rick, I think we will probably leave it here. You've certainly left us waiting for more in the next chat. And please allow me firstly to thank you on behalf of the viewers, and I hope everything goes well in your favor in this current market. So until the next time, to the viewers at home and also to Rick, thank you for joining us, and God bless.
Thank you, Brian.